if I had to think about my hypothesis, I do believe that this is going to be a good idea moving forward and be a net pause investment.
Hi everyone. This is a video run through for the Australian gas gamble case. This is a great go or no-go decision case with a strong focus on quant, but also some qualitative reasoning, chart reading, and brainstorming thrown in. My name's Chris Macrae Ham, and I'm going to be leading the interview. Also with me is Ben Wilson, who'll be playing the interview candidate. So before we dive into the case, let's just do some quick intros. So as I mentioned, my name's Chris. I now work in energy infrastructure development and M&A in New York with a company called Energy Re. Before that, I worked in management consulting. I was with BCG in the New York office for 3 years, with the last year of that time as a project leader in the climate and sustainability practice. Before that, I was at Accenture Strategy in London as part of their energy team for a year. So overall, I spent about 4 years in management consulting after doing my MBA at London Business School. And yeah, before business school, I was an engineer in the oil and gas industry. Over to you, Ben.
Excellent. Thanks, Chris. And this is Ben Wilson. I'm currently a director with Alvarez and Marsal, primarily in their public sector practice. I previously served in the Army as a civilian, and prior to that, had spent about 10 years in management and strategy consulting with a few different firms. Today, for this case, I'll be playing the role of the interviewee.
Awesome. Okay, ready to dive into the case?
Let's do it, Chris.
All right, great. Here's the question. So your client is Woodside Energy Group. They're a leader in the Australian oil and gas industry, focusing primarily on the exploration, development, and production of LNG, or liquefied natural gas. They also do crude oil and natural gas. The company generates about 8 billion Australian dollars a year in revenue, and right now they're contemplating a go or no-go decision on an ambitious natural gas extraction project. It's about 300 kilometers off the west coast of Australia. So this project is called the Scarborough Energy Project, and it's expected to result in 2 billion cubic feet of natural gas per day. So your firm has been brought in to evaluate this project's economic soundness. So I guess with all that information, how would you help Woodside make the decision?
Yeah, Chris, very serendipitous timing. My current client actually happens to be in energy, a slightly different area of that market, but hopefully that's something I can bring into this case. Okay, so it seems like question up front is evaluating whether Woodside should make this decision on the mega Scarborough project. And so a little bit more contextually, client is Woodside Energy Group, Australian based, seems like oil and gas, a few different areas, but primarily LNG. And this mega project, this from the size of it, it seems quite large, 2 billion in cubic feet natural gas on a per day basis. Did I get that right?
That's exactly right. Yep.
Excellent. Chris, before we jump in, maybe I can ask you a few questions about this project and, maybe even a bit about more of the company and industry. So first off is the goal of the mega project. Is there idea behind it to maximize revenue, perhaps diversify income streams, create long-term reserves? Have they thought through that portion of it yet?
Yeah, it's a great question. Really, the primary goal is strengthening its position in the global market. So there is that strategic objective. The finances also play a huge part in this, though. Obviously, they're targeting an ROI of about 15% with a target payback of 8 to 10
Okay.
years.
Okay. Interesting split between kind of strategic and financial objectives there.
Yeah, exactly.
The next piece I was thinking about as you were walking through was upfront expenditures. I imagine CapEx and maybe even ongoing OpEx, especially being so far off the coast, would be a heavy investment. Do they have any idea of what that anticipated upfront cost and maybe ongoing costs are at this time?
Yeah, great questions. So right now, the CapEx is estimated at $12 billion. That's Australian dollars. And then, yeah, for ongoing OpEx, it's a range, kind of an
Interesting.
all-in OpEx with maintenance, labor, transportation, everything.
Okay, you anticipated my next question. That's fantastic. Okay, so 12 billion annually, 203 million annually, 12 billion upfront. Okay, I suppose my last question, just to fully get my bearings here, is understanding the planned capacity. So understanding we have that kind of 2 billion in cubic feet per day. Do we know how long, perhaps, though, this can last for? I'm just thinking about, I know
Yeah.
someone like Bahrain only has maybe 5 to 10 more years, whereas Saudi has, 70 to 100 more years.
Yeah, that's a great point. Let's just assume 30 years for now as the lifespan.
Okay, Excellent. Can work with that. Kind of splitting the difference there. Excellent. Chris, if I could have, maybe a few minutes to gather my thoughts and figure out how I might want to approach this, and I'll come back to you with what I'm thinking. How does that sound?
That's awesome. It's
Okay.
perfect.
Okay, Chris. So I think I have an initial way I want to think about this. Would love to walk you through it. So the way I've thought through this is three primary categories. I'm thinking from an oil and gas market globally. I want to investigate the project financials for Scarborough, the mega project. And then I
Hmm.
also want to think about general risks to consider across a few different avenues. So let's dive into the oil and gas market globally. So first piece I want to look at is competition. What I know about this industry that has major competitors, you have Russia with a large natural gas reserve, thinking to the different oil pipelines and natural gas pipelines that they've had to Europe. You have oil in the Middle East. I've referenced like the Saudi Arabias and the Bahrains of the world. But I'm also recognizing that U.S. fracking has really opened up the U.S. Oil reserves. There's huge areas down in Mexico. You had the boom up in, I think it was like the North Dakota, kind of Nebraska area. So a lot of competitors in this space globally.
Right.
But there's also the customer side of it that I don't want to ignore. And the demand for gas over a 30-year trajectory, kind of what that 30 years that you had referenced we have, is
Hmm.
quite long, but it's a changing environment. There's segments of the industry that prioritize rise in nuclear, there's electrification. So those demand levels may vary into the next 30 years and per those segments. And this then kind of bleeds into market dynamics. So you have a lot of times this industry, I recognize futures contracts. So you lock in those long-term pricing. But given the dynamics of not necessarily understanding where this market could go, I'm curious if that's impacting these traditional dynamics and the price setting. And then, within each of these, the price setters by the OPECs of the world currently could push that and change that aggressively. So that's how I'm seeing the market globally. I want to get into more Scarborough financials though. And I'm thinking about this from kind of two traditional sides of revenue and cost, and then, payback period, which I'll get to. So revenue, it's that price point. I know I recognized that earlier. I think that's going to be the big question throughout that I'm focused on. Demand for global customers, that 2 billion of cubic feet for 30 years is great, but what does that demand look like, and what price points do we have to hit to get that volume? Cost, it seems like we know a lot about one half of it. So we know CapEx estimated at AUD 12 billion and the ongoing OpEx of, 200 to 300 million, call it 250. But this other half that I'm kind of alluding to, I don't know as much about, is any financing. So unless we have the 12 billion in the bank to provide and build this CapEx initially, we probably need to go out and get that loan. So what does that interest rate look like? What are those loans over time? How are our negotiating? So I imagine that could increase the cost considerably. Um,
Sure.
which bleeds into kind of ROA payback. So we need to hit that 15% ROI in that 8 to 10 years. Assuming that 10-year payback and the AUD of kind of 250 million, this is a high threshold to hit. General risks to consider, just to kind of conclude, and I'll lead with my conclusion from or my hypothesis from there. There's regulation across different markets and globally. So Australian and foreign governments could prevent potential sales, especially as you have this kind of divide between traditional U.S. allies and maybe those more allied with Russia, given the current Ukraine crisis. Price fluctuations, especially given that crisis I just alluded to. And then finally, more renewable or less traditional energy sources, wind, nuclear, electrification. So I think those are all risks that we need to consider and factor in. If I had to think about my hypothesis, I do believe that this is going to be a good idea moving forward and be a net positive investment, specifically because I'm thinking about we haven't been able to move across to other renewable energy sources well enough, and 2 billion in daily output for 30 years. It's a high enough volume that I think we might be able to be a good player in the market. But I would like to start by investigating the biggest question mark I have, which is price in the markets. Do we have any data available on current or historical prices across varying markets?
Yeah, that's great. Thanks for the structure. That's really specific and tailored to the industry. I love it. And on your point about the market, that's great. An analyst on your team has actually pulled this data that I'm going to flash up on the screen. We have a couple charts to share, and I'll pull these up sequentially. But I'd love your thoughts on this and what it shows.
Okay. If you can give me just a moment, I'm just going to take some notes down to my observations.
Of course, yeah.
Okay. So it looks like the chart I'm looking at is natural gas prices of Asia versus Asian markets from 2009 to 2023. So little over 10-year time frame, looking at about 15 years. And in this time period, what I'm observing immediately is that the US has stayed very stable, whereas the Asian markets we're seeing greater fluctuation. I mean, outside of this kind of 2012 timeframe, we're seeing massive fluctuations in Asia around 2022. That, if I had to do a quick math estimate, that variance in range prices for Asia is anywhere between 5 and 10x difference. So, two immediate thoughts. Asia is higher risk but higher reward, whereas the US is more stable and probably has fairly consistent future prices.
That is a great point. Those are all really important insights. Yeah, there's clearly a difference between these two markets. Um, how about this page?
Oh, interesting. Okay. Again, just taking a moment to gather my thoughts. Give me just one moment. Okay, interesting. So what we're looking at now is slightly different time period. The last one was 2009 to 2023, where this is 2016 to maybe starting to bleed into 2024. So maybe even closer to the date we are at currently. So factoring that in, but looking at what is the volume per day across these one, two, three, five countries, and a bit into both Asian markets and kind of US, but also Australia. So um, some immediate thoughts that are coming to mind. US has grown considerably in this time period. From under 10 years, fewer than 10 years, it's grown from about zero to now being a market leader. Australia, number two, is also quite surprising. Most of its growth occurred in that 2016 to 2019 timeframe, so stayed fairly stable from there. What's also quite surprising, if I think about the 2 billion per day that Project Scarborough would bring, compared to the 12 billion here, I mean, it would end up being close to 20% of the market volume on a daily basis, which is
True.
quite considerable. Um, I would imagine also, just given where the US is, still ahead in that aggressive climb. US might, on the global scale, start becoming a price setter.
Hmm.
Um, but then also something kind of before I recap my final analysis is that Russia, I've referenced the Ukraine crisis recently, but I don't see that impacting Russia's exports. So although some countries, such as Europe, might no longer be buying from them, their volume has not changed. They're finding other customers. So here's kind of my takeaways from perhaps the last two. Recap the last one. I think there's great opportunity in Asia, but also high risk, whereas the US was fairly stable. Here we're seeing, although the price in the US are stable, it's actually climbing as a market. And I imagine that even if we are 20% of the Australian market, we probably can't grab 100% of that potential 20%. So if we want to pay back this in that time period, I imagine that we need to look elsewhere, and that US market, given its stability in prices and increasing volume size, is starting to look fairly positive. In terms of that and kind of reflecting back on my initial hypothesis, this makes me start to feel like this is a good idea if we can actually enter those markets. But before thinking about kind of like external markets and that success, I'd want to probably dive more into Australia. Again, to my point of, can we get that full 20%? How much of this market share can we get? Do we know anything more about the Australian market? I'm thinking about pricing, size, where we might be able to position.
Great. Yeah, thanks for the points on those charts. I think you got all the key insights. And yeah, let's talk about the market here domestically. So yeah, Woodside is expecting to sell the bulk of the gas from the project internationally, but they are still counting on a steady stream of sales to Western Australia, where this is located. So really what I'm hoping you can do for me is estimate the reserve. So a few just kind of tidbits of information I can provide you up top. Let's assume a local population of 3 million people in that region. And let's assume the gas serves about 50% of the energy needs for that region.
Okay, interesting. All right. So the way I like to do market sizing, just kind of walk you through the approach that I will be doing. I want to lay out what my equation essentially will be. I
Mhm.
want to go through and then rationalize how I'm dividing up and segmenting, and then assign numbers and kind of work through the math from there. How does that sound to yourself?
That's perfect. I love it.
Okay. Let's start kind of like global macro perspective. I want to start with the population. I know you gave me that. I'll assign numbers next to this, but we'll start with the population. I
Mhm.
know I want to break that down by type. I don't necessarily know what those types are yet, but I'm thinking maybe 3 to 4 or 5 categories. So population type. I then want to think about the spend per type. So for each of those segment types that I just thought about, is that spend going to change or not? Um, I then want to do this on an annualized basis. I should be writing this down while I'm doing it. I then want to do months per year. So that's going to be my next piece. And then I want to multiply it by that gas
Mhm.
for the region that you gave me, that 50%. And then that last piece, and this one I might have the most questions about or work through is the market share that we could potentially get. And again, that kind of goes to my references previously of what that number could be. Okay. So let's kind of work through each of these. Population, I know that's going to be the 3 million people you gave me. Thank you.
Right.
Type, as I was working through this, the way I'm thinking about it is I'd probably want to think about residential, homes, apartments, condos. I want to
Mhm.
think about industrial. These are your facilities, your manufacturers. And then I want to think about commercial, like the office building that I'm in currently. I think those three
Right.
would really cover a lot of where I spend my time, and I think where vast majority of population spend it.
That makes sense
Um,
to me. Yeah.
I I want to think about this for simplicity as probably a third, a third, a third in terms of how the market share breaks down. I don't know anything else beyond those assumptions that could constitute dividing it differently. And for simplicity, what I think I want to do is I want to identify one of those thirds. I'm going to use residential, and then I want to extrapolate that across 3x. So whatever I calculate for that, I'm going to multiply it by 3 to get the whole population. How does that sound?
That's reasonable to me. Let's do it.
Okay. So that 3 million is going to break down into those three categories. Average household per person for residential. I know it's about 3.5. I'm going to round up to 4, and then if I need to round down later, I can.
Sure.
Gas, I want to think about gas spend per type. So in this case, I'm going to do it for households. Um, I imagine that's going to be anywhere between, call it 100 to 300. I'm thinking about my typical gas bill, especially in the winter in Chicago. So let's call it 200 for simplicity. We'll do this all in AUD. Um,
Perfect.
12 months per year, which I talked about. We have gas for region, which is 50%, which you gave me. And then we're going to leave market share out for right now. Okay, let's work through some math. So we've got 3 million people. I referenced that we're going to do residential first, so 4 people per household. So I'm going to do 3 million divided by 4. That's equivalent to me of doing like 30 divided by 4 is 7.5. So we'll add those zeros on. That's going to be 750,000 per household. 700, I'm sorry, 750,000 households. And I want to multiply that by AUD 200, which is going to be my gas spend per household. Um, Call it 75 times 2, and I'll add the zeros on. So 75 times 2 is 150 AUD. So that's going to be 150 million AUD for residential households daily.
Mhm.
Um, and so now I want to do, oh, I'm sorry, not daily, per month. And
Right.
so then AUD 150 million times the 12 months per year, because I want to be annualizing it. 15 times 12 is 180. So add those zeros on. Give me just a moment. So for residential households, that is AUD 1.8 billion annually. Okay.
Perfect.
Let me divide this by the 50% and then I'll multiply it out by 3 to cover residential, industrial, and commercial. So we've got the 1.8 billion times the 50%. That's effectively 18 and divided by 2. So that's going to be AUD 900 million market size for residential only. And so then we have 900 million times 3 to count for each of those commercial, industrial, residential again. So
Mhm.
9 times 3 essentially adding on the zeros. So 900 million times 3 is going to be 2.7 billion for my total annual market. Now,
Perfect.
recognizing Chris, I know I still have market share at the end there.
Exactly. All right. The 2.7. Yeah. I mean, as an overall market, I like the math. I think that works out. What do you think is reasonable for our market share in this region?
That's a really great question. I always use as a gut check. I say, okay, what is 10%? And does 10% seem too big? And then I start scaling up and down from there. I know 10% to a new market is hard to obtain. So 10% of 2.7 billion, I mean, you're looking at 270 million. If I think, could they get up to 25% of the market? So, doubling that and another 5%. That's 700 million AUD. I mean, these are large shares. And
Mhm.
again, it sounds like we're in the space, so we have some kind of knowledge of it, which is fantastic.
Yeah.
And we have at least a brand, don't know much else about that. So that feels good. But I'm also thinking that let me reflect back to the investment information you gave me. We know we have 12 billion AUD capex up front, about 250 million in annual OPEX.
Hmm.
I mean, with 10% or even 25%, I mean, I think we're going to need more than that on an annual basis to be able to hit those break-even numbers of, was it about 15% and 8 to 10 years. So what I'm
Hmm.
thinking is it kind of goes back to the data you were showing me earlier. Australian market, we need to gather as much market share as we can, but I'm having a feeling here that we're going to have to go elsewhere. If I think about max domestic Australian market that we could receive of, maybe 500 million in profit per year. I'm thinking profit, bottom line.
Hmm.
That means, minimum to pay back is well over that 8 to 10 years. I think it's probably in around like the 15 to 20 year mark. Just, estimating quickly. So I still feel positive about this from my original hypothesis, but I do think we need to look at and enter foreign markets beyond Australia. Um, so I suppose what I want to think about, do we have any projected sales? Do we have any estimates about what that might look like if we do enter foreign markets?
Yeah, that's a great question. And yeah, I agree with all the analysis and thoughts you shared. So yeah, moving on to that part. So as part of the evaluation, we're hoping to paint a picture of what the operation of the project would look like 10 years out, 10 years in the future. So I'm going to share some information here.
Okay, I'm with you.
Okay. So we've pulled together these best and worst case scenarios for some of the key inputs on the project. So really, we're looking for what's your estimate of the best case and the worst case present day impact of these? Like this is year
Interesting.
10's
Okay.
operation.
I usually have like a middle there of that, sweet spot that I use. So this is going to be quite the range. So once we get this, I imagine we'll have to kind of rationalize between the two. Um, Best case, worst case, already, I mean, 2 billion to 800 million, quite large. What I want to do is, just thinking through my approach right now, I want to do the revenue subtract the OpEx, and then I want to do that. I mean, I see that discount factor. I'm going back to my finance years in undergrad. I want to divide that by one plus probably the discount. And given that we're doing a 10 year, I probably want to do it up to the power of 10 to try and look at that in today dollars. How does that sound to yourself?
Yeah, and I mean, given that neither of us have a calculator right now, let's just ignore the whole compounding aspect and yeah, make life a little easier.
Okay, okay. I'm gonna do a shout out to Rocket Blocks right now. I learned a fun fact when I was actually using their platform back in the day that I learned to do is like number of years times the percent rate, and then I add on roughly 0.01 for every year. So I'm gonna try that. You can maybe keep me honest here and see how close I get. Okay, so I'm gonna do best case and then worst case, and then maybe we can talk through. So let's do the quick math first. The revenue subtract OpEx. So best case, that's 2 billion subtract 200 million. So we've got AUD 1.8 billion in immediate profit. Now I'm going to do the 1.8 billion divided by 1 plus the 5% to the power of 10. So I know 1.05, so 5% times 10 gives me 50%. So the 1 plus that is 1.5. And then I said, zero point zero 0.01 for every year. So 10 years, that gives me zero point 0.1. So I'm doing effectively divide by 1.6. So we have 1.8 billion divided by
Mhm.
1.6. I'm going to kind of switch some decimals. So that's the equivalent of like 180 divided by 16, just changing out one on either side. 180 divided by 16. Give me just one moment. Probably gonna come back to you with a rough estimate. Okay, so 180 divided by 16 is 11.25. Let me translate that back into billions. I'm looking at about 1.1, 1.12 billion. Does that sound about right?
Yeah, that's reasonable. Yep.
Okay, okay. Um, After this, I'll have to check how I'm doing with these decimals. Okay, worst case scenario now. So I've got the AUD 800 million, subtract the 300 million. So immediate profit is 500 million all in AUD again. All right, so now we have the 500 million divided by 1 plus the 10% to the power of 10 in terms of years. So I know it's 10 years times 10% is 1. That's immediately easy. So 1 plus 1 is 2. And now I'm going to do, we have again 0.01 for every year. So this is 2 plus zero point 0.1. So I'm going to do the AUD 500 million divided by 2.1. Okay, I'm going to call it about 2, and then I'm going to round down from there. So I know 500 million divided by 2 is 250. It's probably somewhere between 250 and 200. Given that's worst case, let's take the worst case of that. Let's call it 200 just for estimating purposes, and we'll see how
Yeah,
big that range is.
perfect.
Okay, so if we think about the range from each of those, we have best case about 1.1, 1.12 billion. Worst case, 200 million. I mean, our full range is nearly 1 billion,
Right.
which is very difficult. If we think of payback again, thinking about the payback goals you gave me of the 8 to 10 year target, that 1 billion a year, yeah, we can look at hitting that. That's really good. It's going to be tough. It's going to be tight, but it's applicable. If we think about the 200 million, I mean, there's no way that is just doesn't make sense as an immediate investment. So, um, what I'm thinking about is kind of back to my hypothesis. It depends
Yeah.
on our risk appetite. I still think this seems like a good idea. This is an industry that strikes me as taking on a level of risk, especially with upfront investments. But
Mhm.
again, if they find themselves being risk averse, that downside is huge and may not necessarily be appropriate.
No, you're right. Those are great insights. So let's move on to the last analysis here then. I think your points really lead into it nicely. Given the scale of the project, Woodside is very focused on mitigating risks. So what do you see as the major risks, and how would you recommend the firm hedges their bets?
Okay. Can you give me just one moment? I'm just going to kind of collect my thoughts here on that point.
Of course.
But I have three ways I want to look at this, and maybe I can tell you kind of the major risks I'm thinking about in all three, and then I'll go back through and maybe we can think about hedges for each group.
That's
So I'm thinking about financial risk, operational risk, market risk. These seem like themes that have come up throughout the data and information you've provided today. So financial risk, I called it out right at the beginning, is that price volatility. We see that in the Asian markets. We could see more as the U.S. begins to be able to dictate price given the volume increase. Another piece of financial risk is budget overruns. This isn't something we necessarily saw, but I mean the 200 to 3 million operating, but also the 12 billion upfront for the capex. As soon as that overrun starts to occur, it becomes very difficult. I've seen this quite a bit in energy, especially with these large projects. Supply chain issues, we saw inflation over the last few years, that increase in cost. So this could really become something that's concerning. Um, I next want to think about operational risk, kind of my second category. And I'm thinking about this in a few ways. Project delays. So as contractual issues occur, as supplier negotiations potentially break down and being able to that pushing out potentially months and then years. Um, and then I also want to think about regulation. And when I heard Australia, first thing that occurred to me was kind of like ecological environment, Great Barrier Reef.
Mm,
My geography of Australia is not good, so I don't know if this is near that, but that could factor in, and maybe that the government decides to pull back, worst case, while we're halfway through construction and decides that we can't drill there. So those become certainly major risks to me. And then finally, market risk. So we have competition from other countries. US fracking has opened up a large number of reserves. Countries like Venezuela and Mexico and Colombia actually sit on very large reserves as well. Perhaps they start pumping more and push more into the economy. And then geopolitical conflicts in the Middle East could potentially kick up, or perhaps those decrease and that fluctuates price. Okay, so I promised you some hedges per group. So let's think through those. So financial risk, the big one was the price volatility. Long-term contracts, futures contracts seem like a great way to do this. Can we lock in a price where we know we can pay back in our desired time period and be profitable? Um, Operational risk, perhaps we can build in contractual language that incentivize contractors to meet targets. I know my graduate school, Darden, did this when they were building their hotel. It's like, hey, if you hit this target, we're gonna really incentivize you and make it worth your while. Perhaps we can also use lobbyists to monitor government activity if there is going to be anything coming through government. Um, and then market risk. We can probably monitor prices and supply via the economists in-house. And then maybe even work with some of these countries that have large supplies to give incentives that we want to work. with them, or maybe even, potentially keep them out of the market. So that's how I'm initially thinking about the major risks and perhaps ways to hedge, but certainly a lot to take away there.
You're right. Great. I love the thinking. Um, so yeah, our firm is presenting to the Woodside Board of Directors tomorrow. What's the headline recommendation you can give on the project?
Okay. I'm going to be pulling from a few points throughout the case. So, the goal of our project was whether Woodside should pursue the Scarborough Mega LNG project off the coast of Australia. And at this time, our recommendation is that they should move forward with the Scarborough project. The total estimated annual market for gas is AUD 2.7 billion in Australia. We know kind of the best versus worst case as we enter the global market. The scenarios range from 1.1 billion to AUD 200 million, but we believe that if Woodside ends up on the mid to upper range of that through good cost controls and proper planning, that they can meet that target payback of 8 to 10 years. This isn't without risk, though. So, given this range and the numerous risks, we think the most important one to monitor is the price volatility, specifically in foreign markets, which we need to enter in order to hit that 8 to 10 year payback. Our greatest mitigation strategy would be for Woodside to enter those foreign markets, reaching a futures contract negotiation to establish long-term price negotiations and lock in stabilized prices to be able to hit the payback. As a next step, our firm would love to assist you in an assessment of future rates to be able to determine what that rate structure should be that you need in order to hit that period. Thank you.
All right, awesome. Case done. Um,
Excellent.
so yeah, everyone, Ben did a great job on this case. Walking through it, I think the framework he presented was fantastic. It was very MECE, very industry specific. On the chart reading, he cleared the chart well, speaking to the title and the axes before diving in and reading out, very crisp insights. On the quant, the math skills were strong, but I think what you did a particularly good job of is talking me through your steps as you're doing it. I never was lost in where you were. It was a pretty complex market sizing, but you did it well. And if you struggled anywhere, I'd be able to jump in and help you out. And yeah, your brainstorming was also very structured. So overall, I think you did a fantastic job on the case. And anything to add on your side, Ben?
No, Chris, I really appreciate it. And it was interesting because it was so quant heavy, but it found opportunities to bring in those more qualitative pieces like the exhibit screening and like the risk piece at the end. So it was a really well balanced case that made you kind of go back and forth between quant and qual as you're moving through it.
Exactly, exactly. You did a great job of kind of calling back to those earlier qualitative insights as you were working through the math and just kind of blending it together as we moved along. So that was great. And yeah, that takes us to the end. So thanks, everyone.
Hey everyone, it's Kenton Kavesti here, the founder of Rocket Blocks. Thank you so much for watching this mock interview video. I hope you found it informative and helpful as you are getting ready to prepare for your own interviews and hopefully landing that job offer you are excited about. We have a ton of great content on the Rocket Blocks channel coming out on a weekly basis, mock interviews, mini lessons, and chats with our Rocket Blocks experts. So if you haven't subscribed yet already, please do so. There is a big red button below. And if you hit that, you'll get all of our content as soon as it comes out. Thanks for watching and have a great day.